Silicon Valley, the epicenter of tech industry, where innovation and entrepreneurship meet. For years, Silicon Valley Bank served as the go-to bank for startups and venture capitalists. But in a shocking turn of events, the bank closed its door on Friday, making the biggest retail banking failure since the global financial crisis in 2008. Meet Greg Baker, Silicon Valley Bank's CEO. Baker joined the company 3 decades ago as a loan officer and played a prominent role in steering the lender through the 2008 financial crisis. However, the bank's fortunes changed in the wake of the COVID pandemic. Startup funding started to dry up, resulting in a high number of banks' clients withdrawing money. To honor their requests, Silicon Valley Bank was forced to sell some of its investments even though their value had declined. The bank's balance was parked in long-term duration government securities, which resulted in a significant loss when the Federal Reserve raised interest rates. Here, you have to understand the relationship between the interest rates and the bond prices. The relationship is opposite. When the interest rates goes up, the bond prices goes down. As the pandemic increased, the bank was forced to sell $21 billion of their government bonds at a loss of $1.8 billion. Its shares fell 60%, and now the bank had failed. On Friday, the Federal Deposit Insurance Corporation took control of Silicon Valley Bank's $175 billion in customer deposits. Deposits of up to $250,000 were insured by the regulator. The FDIC, Federal Deposit Insurance Corporation, had created a new bank, the National Bank of Santa Clara, which will now hold all the assets of Silicon Valley Bank, assuring the depositors. The FDIC said that they would have full access to their insured deposits. After all, the branches of the bank opened on Monday morning. The financial body also said that checks of the old bank would also be honored. But what happens next? Silicon Valley Bank has two big problems that need to be fixed quickly. First, most of its large deposits, a unique characteristic of a bank due to its customers being largely startups and wealthy tech workers. And these deposits are not insured by the government. This means that only deposits under $250,000 are protected, leaving many businesses without access to their money. Second, there is no other bank that has offered to buy Silicon Valley Bank's asset. This makes it hard to resolve the issue with the uninsured deposit. Many businesses cannot wait weeks to get access to funds to meet payroll and office expenses. It could lead to layoffs. And there is no buyer of Silicon Valley Bank. Typically, the bank regulator look for a stronger bank to take on the asset of a failing bank. But in this case, another bank hasn't stepped forward. With Silicon Valley Bank's closure, nearly 175 billion of customer deposits are now under the control of the FDIC. The bank's failure could have ripple effect throughout the tech industry, affecting not only Silicon Valley but the entire startup ecosystem. This once promising bank became a victim of rising Fed rates and changing market conditions. As Silicon Valley grapples with this unexpected turn of event, the tech industry will undoubtedly find a way to adapt and move forward. But for now, the closure of Silicon Valley Bank serves as a cautionary tale of the risk associated with banks and investing even in the most innovative and dynamic industries.